Hi, Dan Kurz, DK Analytics. Thanks a lot for tuning in. It's August 14th, 2017. We'd like to come back with a video, an update, the state of the world, and we're going to call this video or title it More Manna from Heaven After All. After a rash of announcements or indications in the last few months that central banks around the world would be becoming more restrictive, reducing QE, moving to outright cessation of QE, or even toying with raising interest rates. In other words, joining the Fed in Japan and China and in Europe, or the Bank of England, we have plenty of signs to the contrary, and that is actually no surprise given the state of affairs, as I often call it, our globally toxic public policy stew, meaning we don't have a system that respects property rights. They are transferred to green cronies or to aliens. We don't have sound money. We have creditors getting smashed by debtors. That is policy made for the benefit of debtors and not creditors. As solvency risks pile up, and so do monetary inflation risks, creditors are being raked over the coals as debtors, most especially including governments and corporations, just keep increasing the leverage thanks to the artificially low interest rate environment, and that has been engineered by the globe's central planners, central bankers, by statists, all right, by people that don't respect free market capitalism, the indivisible hand of Adam Smith, price discovery as the ultimate allocation tool. We've majored in misallocations and debt enabling expansions of balance sheets and statist perversions, to boot. In any event, is more manna from heaven on the way? Or are both the ECB and the Bank of Japan and the Bank of China and the Bank of England not going to follow the Fed's, the U.S. central bank's footsteps in terms of strongly curtailing, or better said, ending bond buying, agency bond buying, and some central banks even corporate bond buying, such as in Europe, or stock purchases, such as in Switzerland and the Bank of Japan, or the Swiss National Bank, SNB. So let's take a quick look at this, and for the following reason. And notwithstanding the tremendous saber rattling and global destabilization potential in North Korea, and the with the nuclear situation heating up, with North Korea's ability to apparently launch atomic payloads towards U.S. cities on the West Coast and perhaps further. Despite this and the recent pullback in stocks, we continue to have stock valuations and bond valuations which are not at all indicative of any kind of constructive, positive future returns, much less any solvency protection on the bond sides, which can be dealt with obviously with a printing press in terms of insolvency in stages, i.e. your money is just debased into worthlessness. But I'm getting ahead of myself. Let's take a look at a couple of the big players. The Bank of Japan's decades old Keynesianism, it has resulted in monetary / economic failure. They're down to roughly 50 billion per annum in purchases, hoovering up of bonds, JGBs, Japanese government bonds, and they've in essence been the biggest buyer, and they've had to go into the equity market, the Japanese equity market, and have been the biggest buyer of Japanese equities as well. And again, we have asset prices in Japan in both bonds or stocks that are based on financial repression, not based on free market capitalism and price discovery. And the Japanese central bank, which recently got rid of its 2% inflation target and hasn't been able to reach it, isn't going to step back anytime soon until it literally prints the yen into oblivion. The ECB, Draghi, a former Goldman Sachs banker, a crony, a Southern European, a Latin, 2-3 months ago came out and threatened that potentially the ECB, probably given German pressure, was going to step back pretty sharply from very aggressive bond and corporate bond purchases. And the ECB is still at 70 billion a month. The Japanese are at 50 billion a month. We have the Chinese and other central banks are still expanding balance sheets. So we've got about a $1.5 to $2 trillion ongoing global expansion in the monetary base and the balance sheet of central banks. And the ECB, of any central bank that we can think of, would have a bit more cover in terms of raising rates or removing its insane perversion of a negative interest rate policy and winding down the rate at which it expands its balance sheet. But let's not forget, Italian banks, the entire European bank system, they are very fragile and they're very loaded to the gills with securities that have long durations and very low interest rates, obviously increase the duration risk if we get any kind of uptick in interest rates for whatever reason, i.e. the bond vigilantes start to run for the hills and don't like what they're getting, which is in essence junk bonds. Virtually all government bonds, with few exceptions, maybe Germany, maybe Switzerland, maybe New Zealand, a handful, are nothing other than junk bonds, not offering any yields, not offering any inflation protection as they print, and obviously inflation is printing more money than the growth of the economy in real terms over time. And they don't offer any solvency protection because all these governments are unable to ever fulfill their obligations, not just the debt, but the promises they've made that are off balance sheet in terms of pensions, in terms of health care, in terms of bailing out institutions such as Freddie and Fannie in the United States. So there's just no way that this is possible. And demographics and aging global society just makes it harder and harder. So where am I going with all this? The ECB in particular, which has a stout German economic engine, and Germany is obviously using the weakness, or has used the weakness of the euro to continue to export. It has the advantages of much lower cost structure compared to what it had when it had the D-mark. But even Germany, logging, or the Eurozone logging about 2.3% growth the first half of this year, spearheaded by Germany and a one-off increase by France and export success. These are really very weak numbers because they come off of a multi-year period of pronounced economic weakness. Hardly any growth in the EU, which is a similar thing that's obviously taken place in Japan, or even worse, and the US. So the EU is weak. The entire OECD world is weak. China obviously has huge debt issues. Speaking of China, its central bank last year, which features, by the way, $3 trillion in reserves, facilitated credit growth of $3 trillion to sustain the unsustainable in China. which is outsized debt growth relative to GDP growth, and that happens as the further in debt you go, the more debt you need on an incremental basis to stoke an additional increment of GDP growth. In fact, China's debt is up 15-fold in the past 16 or 17 years to some 15 times GDP. I'm sorry, it's up 15 times to over 300% of GDP, 15 times in the last 16 or 17 years. So the point is the whole world is in the hawk. Debt levels, as we all know, are too high, and I'm going to get to that in a second. But we don't really have a resumption of price discovery, of regulatory sanity, of national solvency and sovereignty. We're losing property rights to aliens, to takers, to monetary inflation, to green cronyism, and this is leaving scars. And obviously the misallocation based upon governments and big corporations able to indebt themselves at very low levels while smaller concerns, or Main Street, if you will, is gasping for access to credit, even as the regulatory insanity and tax insanity is, and the high fees on fossil fuels in lots of places to support the green crony capitalists is leaving its mark on the cost structure and on demand and on economic vibrancy. So it's a double-edged sword that the free market is being pasted with, even as it supports the statist spending. Right, and a balance which can't be afforded is then obviously covered through the global printing press. This does not sound like it will end well, but our point is the likelihood of the European Central Bank, the Japanese Central Bank, the Chinese Central Bank, the British Central Bank, the Swiss Central Bank, and the Fed of not going tighter or not increasing their promises to reduce QE, to stop QE, as allegedly overtly happened in the United States. Overtly it has happened, covertly God knows. This whole policy doesn't function in a world where you don't have vigorous economic growth and productivity that is the child of sound property right protections, price discovery, not financial repression, and a sound tax and litigation environment. So, and on top of that, we will go over our ever-rising mountains of debt. So if the central banks, here's our bigger point, want to play tough love 6, 7, 8 years into an economic recovery, quote unquote, which lacks any vibrancy because of the sand thrown into the gears of our economy, this toxic public policy stew that I keep mentioning and explaining, then how in the heck are governments going to fund even larger deficits as our global economic downturn gains steam? It just isn't going to fly. And even the Fed, and this comes down to the 800, or brings us back rather to the 800-pound gorilla in the room. Even the Fed, Janet Yellen, in her brilliant, quote-unquote, stewardship, has, after being macho on raising the Fed funds rate, and we've only just begun, and all this other happy stuff, on July 12th came out and made the unbelievable statement that we are close to interest rate nominalization. I'm sorry, normalization, not nominalization. I couldn't quite catch my tongue there. But the normalization of the Fed funds rate historically would be in the 4 to 5% neighborhood, not at between 1 and 1.25%. But perhaps the retail fiasco, the multi-year weakness in manufacturing, the gathering downturn in construction, the flagging auto sales, the debt bubbles, whether it's in autos or in student loans, a real estate market which has been feeding on this low-cost money, as I mentioned, also turning down. Maybe the signals here, together with over 94 million Americans that are not in the workforce but are of working age, combined with jobs being created that are part-time and lack benefits and high wages, even as America continues to hemorrhage manufacturing payroll numbers, manufacturing employee totals, the higher value-added jobs, right? So maybe the Fed is addressing economic reality instead of the fudged inflation, the fudged unemployment statistics, which belie the true employment picture, as we've discussed frequently. In other words, the jobs that are being created are either the birth-death model, which overstates them, or they are part-time and don't pay well, and you count two part-time jobs the same way you would one full-time job. So go figure. But here's the Fed looking to turn. We have the dollar, which we've long said is an overvaluation accident waiting to happen, or that is to give way. And we could well be in a position, especially if we get heightened geopolitical tension, especially out of the Korean Peninsula, we could be in an environment where central banks have to resort to more aggressive monetary easing, be that not just sustaining QE, but heightening QE in Europe or even in Japan, and the U.S. coming back with overt QE and ending its interest rate tightening cycle. This, I think, is what has brought stocks up until our recent geopolitical issues here with this tremendously risky poker game being played with North Korea. And I have the sense that central banks and even Janet Yellen and her merry band of Marxist social planners will have to come to the rescue if the stock market takes it on the chin. Now, Janet Yellen, I think, has an agenda to, together with a lot of other people in the U.S. government, and I say that on purpose, to take down Donald Trump. Now, this man, however flawed he is something that the deep state, the bureaucrats, the leftists, the statists want to get rid of, including the rhinos, the people in his own Republican Party are stabbing him in the back. We went over this in April in a video that Donald Trump is a lame duck in essence. All right, he's been rendered powerless by both sides of the aisle and the bureaucrats, which run the apparatus, the deep state, if you will, including the FBI and the CIA and the whole fake Russian story. So Donald Trump, even if he gets the right things right and wants to do good things, can't do anything. And I could well imagine Janet Yellen and her central planning socialist buddies raising interest rates maybe one or two more times, despite her talk of interest rate normalization. Why? To take down the stock market, which Donald Trump has stupidly taken credit for. It went from a big, fat, ugly bubble, 4,000 Dow points earlier, to him making progress, when in reality, none of the initiatives that he promised to launch have made any headway. Not the good, the bad, or the ugly. And this is obviously very problematic. And the central bank of the United States, I am convinced, they want to have Donald Trump own his stock market, which comes under lots of pressure. But one more reason, investors, for you to consider lightening up on stocks that are approaching nosebleed 30 PE levels throughout much of the world, and bonds which are yielding next to nothing, in extreme cases negative yields, in all cases way below a real world tap of inflation. So it's an opportunity, right? Central banks staying the course, shying back from really aggressively more strict monetary policies, and I have to say that with great caution, because nothing is strict relative to old days. When you take a look at the fact that the Fed funds rate, as I mentioned, used to average 4% plus, you didn't have massive increases in balance sheets, you didn't have zero interest rate or negative interest rate policies, but again, how far are we in debt? And here's something that'll give you some flavor. In 2007, right before the stock market headed south, we had counterparty problems. We had the Fed bail out Wall Street, and European Central Bank bailed out failing European banks at the expense of the taxpayer, at the expense of Main Street. We had debt levels around the world in terms of interest-bearing debt, not promises in terms of Social Security or healthcare, but interest-bearing debt of about 149 trillion. We currently, as of the last quarter, have 217 trillion, a nearly $70 trillion increase in 10 years, or almost 7 trillion per annum. Meanwhile, the central bank balance sheet of the world, if you will, the major central banks, has in that same period, the last 10 years, has gone from 6 trillion to nearly 19 trillion. Right? It's up threefold, and debt is up 48%, or nearly 70-fold. So you take this increase in the 13 trillion more balance sheet of central banks of the world has given birth to, in a fractional banking system, $68 trillion more in debt. This is the over 300% of the globe's output of the global GDP. Why is this so important? Because all of us know at a personal level, at a business level, that when you go into debt, you progressively need a larger part of your income to service it. Well, we've now had artificially financial repression. In essence, the central banks, which are nothing but extensions of statist governments, determine the price of bonds and thus the yield, and by extension, the PEs of stocks, thanks to yield deprivation around the world. And this all isn't always going to work, because both the solvency risks and the inflation risks in a crack-up boom situation associated with just beyond the pale, unprecedented monetary base or balance sheet expansion of central banks, which has facilitated this huge increase in global debt at the government level and the corporate level and at the individual level. This makes the economy, the global economy, what? Much more interest rate sensitive. Meaning, let's round that 217 trillion up to 220 trillion. I mean, debt increases 6-7 trillion a year, and maybe we're already at 220 trillion from Q1 of this year. Let's say interest costs go up, borrowing costs for governments, all right, and other entities or corporations go up by just 1% per annum. Well, that's 2.2 trillion more in global interest service costs, especially given the fact that a lot of people have indebted themselves at the short end, so they have to refinance, especially the U.S. government, which enjoys roughly 1.2% financing costs thanks to the short duration nature of its portfolio. But what happens if a world all of a sudden sees some kind of interest rate normalization? And I'm not even talking about, from boom bond markets featuring virtually no interest rate no compensation, no real returns, no risk compensation, inflation, or solvency. Let's say we move globally from an average of maybe 2% to 3 or 4. Well, if we go from a 2% average bond yield in OECD countries to 4, and I'm throwing in corporates into the till here when I say it, because obviously government bonds can offer even much lower yields or even negative yields in some areas. Let's say we add 2 percentage points to the borrowing costs, and we have $220 trillion in global debt. Why, that's $4 trillion, or $4 trillion, $4.4 trillion more, in annual interest expense, which is fully 6 to 7% of globe's GDP. In other words, it's unaffordable. Why? Because we don't have economic growth, because we don't have productivity. We have misallocations enabled by the printing press, conducted by statists and the benefit of makers and cronies at the expense of makers and Main Street, right? It's monetary policy conducted for the benefit of takers, of cronies, from Wall Street to the Fed, to the green cronies, and beyond, all right, to Obamacare, which is the biggest transfer of wealth of all. In essence, is bigger than most people's mortgage payment, and which is really killing the economy and hasn't been addressed either. So we're just filled with all these difficult policies, these toxic public policies too. So if interest rates do go up, and at some point they will, and recall, we don't go from boom to average valuations. I keep saying this. Analysts are out there say, oh, you go to a median valuation. Well, median valuation in investment-grade government bonds, long histories, Great Britain, U.S., about 4%. We don't go from 1%, 2%, no percent to 4%. No, we go from boom to bust. We go on interest rates of government bonds from 0, 1, 2% to 8, 9, 10. That's the same thing that happens with stocks, which go from 26 or 27 times earnings to 7 times earnings. There is no move to the mean, regression to the mean. It's beyond the mean. And if we have such overvalued bonds and stocks and real estate, which is part of the parcel of the cost of money to deal with, then guess what? The central banks will eventually purchasing $1.5 to $2 trillion a year in bonds or stocks. We have, globally speaking, bonds, the investable assets, all right, bonds, stocks, primarily these, are some $300 trillion. About 2/3 of those are bonds, so we're looking at aggregate bonds of over $200 billion. If people start to sell off bonds because they're worried that they're standing there in their shorts or without any clothes on at all, not getting any returns, yet facing bigger and bigger solvency and inflation risks, what does that mean, ladies and gentlemen, if $200 trillion worth of bonds, or just a small percentage of those, gets thrown onto the market? There's no way they will not overpower central banks, right? So we'll have pressure on bond prices, and as we know, the 10-year Treasury sets, that's the so-called risk-free rate upon which all other net present values, including stocks, including real estate, are based. So we're looking to what? To troubled waters on valuations. And on the other hand, we know very well that as soon as the stock market really breaks, and Yellen can blame Trump for this because he's taken ownership of the stock market bubble. It's no longer ugly. It's no longer big. It's now his bubble, and it's just bigger and better, right? That's just nonsense. But when the stock market comes under significant pressure, which it will, given where earnings have to go, don't forget, despite the 10 or 15% increase in the latest quarter year-over-year earnings after 2-3 years of downward earnings or stagnant earnings, these are based upon very artificial earnings residuals and earnings per share, which has been turbocharged by, you guessed it, stock buybacks as afforded, as financed by the central bank's zero or near zero interest rate policy and the ability of large corporations, the cronies, to get access to these funds, which Main Street can't. And Main Street and small companies is where economic growth, new hiring, R&D takes place, so we don't have that to boot, which is another reason that productivity is so poor. But now let's step back and think about this one more moment, if we could, or if I can have you run through this in your own mind. At some point, all right, these bubbles are going to pop. Central banks will lose control. Let's say they're already sensing the inevitable. I think that's true. They're going to stop with their statements that we're going to reduce our QE in Japan and in Europe. We're going to get back to overt QE in the U.S. But first we got to have an accident. First the stock market in the U.S. has to give way. And again, with PEs at 27 and lacking organic growth, John Williams, his shadow stats, come out and said that if you corrected corporate top line for stock buybacks, that you would actually have, on a per share basis, something like 30% less sales, right? So it isn't an organic growth, it's financial engineering-based growth. Add all the debt, the huge increase in global debt, whether it's government or whether it's corporate or whether it's personal debt, then you're going to have a much weaker recovery, especially given how misallocated the economy is, especially given the tumbling productivity numbers, which frankly brings me to AI and robotics. All right? We have a problem in education, a mismatch, skill sets. It's very difficult. It's not like the agricultural and the industrial revolution where people went from the farms to the cities. We don't have a big productivity wave. Our aggregate CapEx has been heading south, including very vitally in the dense energy patch, oil. We're soon going to run into issues in terms of oil supply. But moreover, in a general sense, we are not retraining the workforce, and there are just too many demographic aging issues. We have this huge uptick in transfer payments just thanks to the aging society. So these two things together and our aggregate lower CapEx spending are drawing productivity growth down and threaten to go negative despite AI, despite robotics, and frankly also despite the Amazon effect. I discussed this with a colleague recently. Amazon is supposed to be the disinflationary, deflationary force in retail and beyond. But guess what? Amazon in 20 years, if memory serves, has not had one profitable year. They've written or had billions in red numbers, not earnings, but losses, and they're being financed by a market which is being pushed into speculation thanks to our zero interest rate policy around the world. So this too is not something that is akin to a traditional growth company which through smart CapEx and good R&D was able to reduce the unit costs and sell as a result their wares or their services for less and grow the bottom line. In other words, the average selling price didn't go down quite as much as the increase in affordability or the volume or how much was purchased. Amazon is no growth company. It's a company that just makes bigger and bigger losses and sucks up a lot of capital. But a lot of that is a function of, you guessed it, financial repression. So this too is not a sustainable disinflationary force. Against all that, what's an investor to do? I'm going to repeat. I know I sound like a broken record, but it's true. Sell overvalued stocks and bonds. All right? Unless you purchased stocks, at a fraction of today's levels where you've got a 12% dividend yield because you've had them for 20 years, then no need to worry. But what about the people that bought them at much more elevated levels? You have capital at risk. In bonds, also, a lot of capital at risk. And if you can step back and use this current round of central bank reneging on their tightening and hopefully not being pushed into a much lower valuation thanks to a tremendously negative geopolitical risk, in a worst case, nuclear bombs being thrown, and tremendous potential loss of life and a tragedy of that magnitude. I'm not even going to go into electromagnetic bombs and everything else that threatens us. There are bigger and bigger geopolitical risks. That would all be somehow containable, understandable if we didn't have valuation bubbles. We had productivity, we had solid economic growth, and we had constructive demographics. But we don't have any of those things. Yet we have pie-in-the-sky artificial valuations. That's the opportunity and also the risk. If you don't take some of those funds and get out of these overvalued bonds, stocks, and real estate, and when you park that cash, not in banks, because you're going to get bailed in. Well, legislation throughout OECD is there. You're going to get bailed in, and you're going to have a high risk of getting bailed in. Excuse me. So what can you do? Go into treasuries, bills, 1 month, 2 month, 3 month bills, and consider, and I know here too I'm going to sound like a broken record, consider purchasing precious metals held outside of the banking system in your own safe, in a repository that you trust, preferably not too far away from you. And with your current account, for that part that you don't need, consider gold money, a Schiff Gold joint venture with a British gentleman. For the sake of declaration, I have a $220 account with them. And this is a current account which allows you to revisit our old system where paper money was backed by precious metals. Recall the days, go on YouTube, go on Google or Yahoo, go look up a 1964 US dollar note, US Treasury note, not Federal Reserve note, and take a look what it says on the bottom of the 1 or the 5 or the $10 bill. It says redeemable or payable to bearer in silver on demand. So we used to have paper money that was backed by precious metals. We don't anymore, but with gold money you can revisit this, because I believe very strongly that the world is going to crave precious metals as insurance, as real money, as wealth preservation in both deflation, debt-based deflation, or monetary-based inflation, the crack-up boom that follows once debt deflation forces central banks to hit the accelerator and to print their paper currencies, unbacked paper currencies, into oblivion. And speaking of unbacked, that's also why I don't think cryptocurrencies are investments. I'm not even sure they're going to be currencies. I mentioned, I think I call them units. They got a great technology, blockchain, get out from under the government. But these aren't stores of value. There's nothing behind them. And let me revert you to the earlier video on this topic for more detail. I think it was a month back. What is the story then for those people that have been able to part ways with bubble valuations in bonds and stocks and real estate and want to go save cash? They go into treasuries, they allocate some of their current account to gold money or a similar instrument, and then they ought to consider with the rest that they reduce their exposure in overvalued stocks and bonds in putting that in, as I mentioned, into physical silver and gold, held outside of the banking system and not stored in a safekeeping box in a bank because Department of Homeland Security will take it away. They can. It's all on the books, all right? And let's go one more step. In addition, and I've said this before and I keep saying it, in addition to these assets, consider dense energy, fossil fuel complex. Can't go without it. Powers the world no matter what anybody says, and will continue to. But it's getting scarcer, harder to get out of the ground, and thus it's a great scarcity asset, and it's a real asset, and it's an inflation hedge. And the same goes for agricultural assets. In tough times where currencies get massively debased and economies go head south, inflation tends to go up because the national banks, the central banks can print. And guess what gets more expensive each and every time? Energy and food. Energy and food. Let me step back for one more second to some gold and silver numbers, if you'll indulge me. It goes like this. There's roughly $340 billion of above ground silver. There's roughly $8 billion of above ground gold. Much of that silver is very difficult to access. It's in landfills and iPhones and old computers and laptops. Much of the gold is held in very firm Eastern hands. Now, portfolios globally, investable assets, mainly bonds, about 2/3 bonds and then stocks. All right, 200 trillion, 100 trillion, roughly, all right, have only 0.5%. That's the residual, right? You got about, say, 65% bonds, 34% stocks, and about 1% left over. I hope I'm getting to 100 here, but I hope you get my point. You have about less than 1% of global investable assets are in physical gold and silver. And most mandates of account managers and portfolio managers forbid them from holding it. They even can't hold ETFs, which are poor substitutes. But let's go through the theoretical exercise here for just a moment. If the global portfolio managers decide that they want to increase their 0.5% representation in gold and silver, even if it's through ETFs or paper vehicles or what have you, from 0.5 to 1%, that is $1.5 trillion a year. Now, gold production, silver production is the equivalent per annum. About 15 billion in silver is extracted from the Earth's crust, and about 130 billion in gold. Meaning, if all of a sudden there was just a small reallocation, small in terms of the percent of the entire assets, from 0.5% to 1% in gold and silver, or gold and silver type of assets, their ETFs and what have you, you're talking about the underlying demand for gold and silver requiring to fulfill this from mining over 10 years of mining. Over 10 years of mining, given how scarce it is and how difficult it is to get out of the ground. What's my bigger point? Obviously, this will bring a higher clearing price. You're going to have the demand curve move up and to the right because supply doesn't move very easily. This is the big opportunity. All right, this is the big opportunity. We have just a small reallocation towards gold and silver, and most of it is going to be gold, right? Is going to knock the socks off of the ability of an industry to supply it by mining. And what is already above ground is going to be hard to access because it's either in firm hands as far as gold in the east, or It's in landfills, over-exaggerated for silver. So you're going to have an investment where all of a sudden just a small incremental increase in global demand relative to the entire investable asset universe of 300 trillion plus, you're going to need a much, much higher clearing price for gold and silver. All right. And if we get any incident, any black swan, whether it's geopolitical, whether it's major bankruptcy, whether it's just people getting cold feet, they will inevitably respond by reallocating more of investable worth into these two metals, gold and silver. And people that buy them before this reallocation occurs are going to be sitting pretty. And here, a thought, one last parting thought. If you consider the fact that U.S. currency, or better said, U.S. Treasury notes, $1, $5, $10 bills, and so on, were fully redeemable to the bearer on demand in silver in the United States. And you go and you cover the U.S. Fed's, or the Fed's balance sheet in gold, and by extension you include silver, because silver is, as I mentioned, has been money for a long time until it was fully demonetized in the mid-60s. That would require, given the U.S.'s alleged gold holdings of 8,333 metric tons, to cover the U.S. balance sheet with that amount of gold would result in a per troy ounce price of gold of almost $17,000. And it just so happens that the monetary base is roughly a third of the money supply in the U.S. So you wouldn't be covering the entire money supply. It's a fractional reserve banking system, but you would be covering the monetary base, which is roughly a third, which is a pretty realistic number in terms of looking for precious metals coverage. If by extension you step back and you said, well, silver, also constitutionally based in terms of up to the mid-60s, was money, or you had a U.S. Treasury note that allowed you to request the corresponding silver from the Treasury, why then silver, if you valued it at a tenth of gold as it comes out of the ground, and wow, it was valued before it was demonetized around the world, you're looking at a theoretical silver price of $1,700 per ounce, and a gold price to fully cover the balance sheet of the U.S. with the alleged 8,333 metric tons of reserves of about 17,000, all right, the $4.5 trillion U.S. balance sheet, which, as I mentioned in an earlier video, they're not going to be able to shrink, much like they're not going to be able to normalize interest rates, other than to maybe to have Trump become totally neutered, up at one more, and then they can claim it's on his watch. But compare, if you would, today's gold price of roughly $12.70, $12.80 per troy ounce, it's August 14th, 2017, with 17,000. Compare today's silver price of about $17 to $1,700 if the dollar was forced back onto precious metals coverage in terms of covering the balance sheet of the Federal Reserve with gold, and by extension silver would be, if you will, the people's money. And from $17 to $1,700 on silver, that's really going places. We don't for a minute expect it to get there, but we do expect, given all the dynamics we've mentioned, that silver will go up 10, 20, 30, 40-fold. You tell me, and it'll depend upon how much money they print, because they will not go back to gold or silver backing until they absolutely have to. But at that point, they will have lost control of the system. Through bond vigilantes, people voting with their feet, will have higher interest rates, will have higher rates of money printing, We'll have much higher rates of inflation, also associated with a dollar that falls totally out of bed because America requires 500 billion a year in external financing, and people are requiring less dollars with which to conduct trade because they're not conducting as much of it in dollars. There's about 17 trillion of them floating around overseas, according to John Williams, in any case. So all this is building up to be a perfect storm. Weak economies, despite the recent euro number, weak global economy, heavily over indebted, huge amounts of money printing, huge derivative risks. '08 revisited, could happen at any time, and declining productivity, an aging economic cycle, negative demographics, people realizing they're not going to have their pensions aren't going to be money good. I mean, talk about the biggest reset of all time that we're steering into, with gold and silver held down artificially through naked short selling of massive magnitude by the COMEX, by the LBMA, and by the bullion banks that are controlled by the central banks or own the U.S. Fed. I mean, this is such an opportunity for anyone that thinks beyond his nose that I can't stress it enough. Let me end there. I'm a bit long in the tooth here. We will be back more frequently, or endeavor to. We hope you find this useful food for thought. Over and out.